Good afternoon. This is Arn Cenedella, Spark Investment Group from Greenville, South Carolina. Hope you're all having a great day. Spark Investment Group does have a coaching and mentoring program for people who want to start investing in apartment buildings on an active basis. But our core business is providing passive investments in the multifamily space, specifically in the upstate of South Carolina, for individuals and families who would like to invest in real estate, but don't either have the time or the knowledge to do so safely and securely. They're busy with family, with their jobs, church, and community. And so passive investing offers people an opportunity to receive the benefits of real estate investing without having to deal with the day-to-day aspects of operating rental property. My name is Arn Cenedella, and I've been in the real estate business, I think now going on 46 years. So I'd like to share some of my experience and provide a little bit of counsel and advice to passive investors who are starting to evaluate opportunities and what should they really be focusing on? What should they be considering? How do they end up making a good decision for themselves and their family? So I'm going to run through a list of 15, 20 notions, concepts that you should probably address and evaluate before going into any passive investment. So the first one is about the operator, also known as the lead sponsor. And those are the people who are really in charge of the investment, running the property. And as a passive investor, you're turning over your hard-earned capital to them in the belief that they will handle it properly and also provide you a good return. So, number one, it's very important to thoroughly kind of vet the operator. What is their experience? What type of properties do they typically operate? What's their track record? How have they done over the years in the syndication business? So they should be willing to give you referrals of happy investors in their database. So really take a close look at the operator, make sure what they're saying makes sense to you. Try to understand who they are, how long they've been in the business, and what kind of success they've had. Step two would be network as much as you can with other people who are also making passive investments. So you may have friends at work or in your neighborhood or doing passive investments. Maybe you're in a couple social media groups. And so reach out to your network and see if any folks in your network have had experience with a particular operator that you're considering investing with. So network, talk to other investors. They'll say, yes, this operator did great. This one I'm not so sure about. And take that into consideration while you're doing your due diligence on the investment, which brings us to number three. This involves more due diligence on the actual asset, the actual apartment building that they're buying. You should get an investment summary. It should give you an idea of how many units, how big they are, what the age is, what the current rents are, what the business plan is, where does the operator estimate they're going to bring rents to, what are the potential returns. So use your own judgment about the information within the investment summary. If they're investing in Dallas, Texas, you can certainly go to the web and get information on the market in Dallas, Texas, even if you're not familiar with it firsthand. So really kind of evaluate the asset. If they're telling you it's a Class B, which is a pretty solid asset, but when you look at the pictures, the area looks a little rough and the building looks a little rough, it's probably not a Class B building. So use your judgment, review the investment summary, look at the numbers. And I understand many people don't have the full experience needed to evaluate the numbers, but just take a look at them and see if they make sense to you and if what they're talking about makes sense to you. So do due diligence on the actual asset. The other next step would be sure you understand what type of financing this property is being purchased with. If you've been kind of investigating the syndication space lately, I'm sure you've heard of problems with floating bridge debt. At Spark Investment Group, we only get fixed rate debt. All of our deals are going well. The deals that seem to be in trouble have gotten the fixed rate debt. And of course, interest rates have gone up dramatically over the last couple years. So be sure you understand what the debt is. Is it fixed rate? If so, for how long? Is it floating? Is there a rate cap? Be sure you have a good handle on the debt and make sure that that feels good to you and you're comfortable investing your hard-earned capital with keeping the financing in mind. Fifth point would be, in my mind, and the way I've always invested over 45 years, is capital preservation is key. When I make an investment, yes, I want a good return, but more than anything, I want to know that my capital's safe and I'm going to get it back and make some profit. Yes, I'd like the profit to be as large as it can be, but I'm less concerned about the profit per se as making sure my capital is safe and I'll get it back with some kind of reasonable return. Coming back to the operator, the sponsor, probably the critical factor in the deal, certainly the property, the numbers, the market are all important factors, but ultimately at the end of the day, it's the skill of the operator that is really going to make the difference on success or failure of the investment. And so there are different operators for different type properties. So for example, at Spark, we only own assets in the upstate of South Carolina, basically Greenville, Spartanburg, with a real focus on Greenville, where my operational partner Brian lives, where I live. It's a market we know really well. In addition, we actually like the smaller properties, sub 100, and we've had great success buying 30, 40, 50 unit buildings and doing well with them. So that's kind of our niche. That's our specialty. We do well at it. So if you had invested with me in 2022 in a 40 unit deal in Greenville, South Carolina, and next month I come to you and I go, hey, Sally, I just found a great 350 unit building in Dallas, Texas, where, by the way, I don't own anything and I don't know anybody there. Sally, do you want to invest? If I was Sally, I'd kind of scratch my head because it would be, Arn, I know what you do it well. You're focused on Greenville and these smaller assets. You're a pro. I'm very happy with the results. But now you're bringing me an investment that's totally out of character for the kind of investing I do in a market that I don't have much experience in. So review the operator and make sure they have multiple assets in a given market. And if their specialty is 1970s value add, they may not be the best operator for a brand new luxury apartment downtown. And similarly, if an operator does great with Class A luxury apartments in Austin, Texas, that doesn't mean he's the right operator for a 1970s heavy value add in Mobile, Alabama. So there's horses for courses. Operators have certain specialties, and I would try to invest in deals where the operator has a proven track record with that kind of specific asset. There's an old expression, what is it? Jack of all trades, master of none. And it applies to syndication too. The other thing as a passive investor, you need to kind of identify your investing criteria. Are you looking for current cash flow now? Perhaps you want to leave your W-2, perhaps you're getting towards retirement, and so cash flow is primary. On the other hand, if you're early 30s and your career is just ramping up, you're making good money, you have no desire to leave your W-2 anytime soon, then maybe your approach is more about how do I grow my net worth over the next 10, 15, 20 years to help my kids pay for college, set myself up to be work optional at the age of 50, set myself up for a nice quality life in retirement. So identify your goals, and typically they're going to come down to cash flow versus appreciation and equity growth. Identify your goals and then pick investments that suit those goals. Another point, risk reward. I tend to be a little bit conservative. I'm willing to earn a lower return on my investments if I feel they are safer and less risky. So each investor kind of has a certain risk tolerance. And so I would submit the deals that promise the bigger returns, 20% IRR, 22% IRR, generally come with more risk. Yes, they may work, but they may not. And so you just need to assess your comfort level with your choice of potentially higher returns with potentially higher risk, or are you more an investor that will go, hey, if I can make 13, 14% on my money every year safely, sleep at night, not worry about it, that's fine with me. I don't need to make 20%. What I need to do is just consistently hit base hits. And over time, I know I'm going to win. So evaluate your risk tolerance level. We've already talked about this a little bit, but kind of research the market that you're considering investing in. And, I would not even be opposed to, if you live in San Francisco, California, and you're thinking of investing in Charlotte, North Carolina with an operator, and you're thinking of investing $50,000, $100,000, it might be money well spent to actually get on a plane, go put eyes on the asset and at least the market. So I just throw that out there. You can research markets online, but I would say if there's areas where you're going to particularly be investing over the next 5 or 6 years or considering investing, I'd spend some time there and go and see for yourself. You'll be able to tell is this an area with this go-go vibe? Is it positive? Is it growing? Is it dynamic? Or do you sense trouble? So evaluate the markets you're investing in. Um, One of the real nice things about passive investing is it is easier for passive investors to be able to diversify. And by that I mean, if you were to go out and buy a, I don't know, 30 unit apartment building in town A, and it would take you $500,000 cash to go ahead and buy that, well, then you'd have $500,000 in a particular property in a particular market. Where with passive investing, you can invest some in Greenville, South Carolina. You could invest some money in Salt Lake City, Utah, Raleigh, Durham, North Carolina. You could also diversify not only by geography, but by asset class, meaning maybe you have some invested in downtown luxury apartments, and then some other money invested in suburban garden style apartments. And so, as a passive investor, it's easy to diversify your capital. And I would submit, in a somewhat unsettled financial world, in my mind, diversification is one way to minimize risk. So evaluate the type properties you like. Are you okay with older that maybe offer more value add potential? Or do you prefer newer properties where it's more steady as she goes and so forth? Um, and of course, if you have an attorney or a tax advisor before investing, uh, reach out to him or her, get their kind of input and so forth. Um, Syndication structures vary very much deal by deal. Some have pref payments, some do not. Some have 80-20 splits, some have 75-25, some are 70-30. Some have different shares of limited partner shares, class A, B, and C, and they all act a little bit differently. So be sure you understand the structure of the syndication, how and when the general partners get paid, how and when the limited partner passive investors get paid. So be sure you understand the structure. And of course, there's an education process to this, but you can start to get educated. The general partner and his team, her team, should be willing to walk you through the structure and answer all questions about it. If they're unwilling to kind of walk you through it, I might consider, is that really somebody who I want to invest with, who can't or doesn't want to take the time to make sure I fully understand what I'm investing in? Um, be sure the cash flow figures make sense. Uh, you're trying to invest in cash flow generating properties. So be sure you look at that, because ultimately, at the end of the day, the cash flow is what pays the debt. And essentially, as long as the cash flow is enough to pay the debt, you're in good shape. Then we're 5 years down the road, and now it's time to talk about the exit. So, what's the business plan? How's the sponsor going to do that? Is he selling the property, or is she going to refinance the property? How does that all work? So, what's the game plan going in? How are you going to exit the property? Make sure you kind of understand that, how you can see where the finish line is. And again, make sure that that makes sense to you. Few final tips, and then we can wind it up. Invest with a long-term perspective. In my experience, real estate is a long-term investment strategy. It's tried and true to the degree you can look long term and invest accordingly, the chances of success really increase. So take a long term perspective, not get rich quick, but regular investing over 5, 10, 15 years in passive investments should really increase your net worth and also your passive income. Um, excuse me, I got a tickle in my throat. The other thing is, not every deal is going to be a winner. If you were to pick 10 stocks to buy, 10 mutual funds to buy, and 7 of them did great, and 1 or 2 of them didn't do so well, and 1 or 2 had some trouble, that would be a reasonable batting average. So understand not every syndication deal is going to go perfectly. And if you do invest in one that doesn't go as well as you thought, um, step back and kind of evaluate what factors may have entered into that so that you can kind of continue to educate yourself so you avoid making that mistake again. It could be an operator not familiar with that market. It could be unsophisticated use of floating rate debt. It could be overly optimistic rent projections, underestimating CapEx expenses. So try to understand on the deals that did great, what were some of the factors that contributed to them doing well? And on the deals that didn't do so well, what were those factors? So continually educate yourself. And then one final point. If you're not comfortable and you feel you're being pressured by the sponsor, my advice is just to say no. People may tell you this is the greatest deal ever, deal of a lifetime, deal of a century. Well, after 46 years, I've seen a lot of good deals and a lot of bad deals, and they seem to come on a regular basis. So don't let anybody pressure you into making a decision. It's better to have done nothing than have missed out on a deal that potentially could be profitable, which brings me to one final point. If you have a sum of capital to invest in real estate, in passive investments and syndications, do not put all of that capital in one deal. That, in my mind, would be a bad mistake. We've talked about diversification by geography, by asset class, and so on and so forth. I would also diversify by deal. So if you have $250,000 to invest, my recommendation would be put $50,000 in 5 different deals. Evaluate how those sponsors perform, how those deals perform. And then as time goes on, you can further evaluate where you want to put your money. But I think as you initially get into this space, spread the capital around a little bit, hedge your bets if that's what you want to say, diversify, kind of protect yourself from making the big mistake. And then I think you set yourself up for longer term success because you will then be able to see for yourself which operators actually perform and provide what they promised and which ones fall short. And then you adjust your investing strategy as time goes on. So hopefully this has been helpful to you. I strongly believe in real estate, and for people who are too busy or lack the knowledge to successfully do it on an active basis, I think passive investing is a great way to diversify your portfolio. And again, I'm fine with stocks and bonds, have some of that, but also have some real estate in your portfolio and take a long-term perspective. Try it out, see if you like it, and build your wealth that way. So, hope this has been helpful. And if you have any questions, just reach out to me anytime. Happy to help in any way I can. This is Arn Cenedella, Spark Investment Group. Have a great day.